How much do I need to retire? Should I stay invested? How do I make sure I don't run out of money during my retirement? These are all extremely common questions I get asked by my clients on a daily basis. So in this video, I'm going to answer the 7 most common questions I get asked about retirement and explain how you can ensure you don't get caught short in your golden years. Now, the biggest question I get is how much do I need in retirement? And this comes out so often, and so many advisors expect you to know the answer to this question before you even come into their office. The thing is, the answer is incredibly difficult, and it depends heavily on your personal situation. A lot of the people I work with are self-funded retirees. They're professionals, they've been business owners, or they've had a career and saved money via the superannuation system. A lot of the people I work with are those that are looking to travel extensively overseas during their retirement. Generally, these people have earned in excess of $100,000 per year during their career. Now, in my experience, when they transition into retirement as a self-funded retiree, they're looking at a base cost of expenses of around $80,000 to $100,000. Now, that's probably a lot more than what a lot of people expect, and it's very different to the ASFA retirement standard, which I'll touch on shortly. Essentially, people that have a base level of $80,000 to $100,000 in after-tax expenses. The key here is that once you start including travel into this, if you're thinking about overseas travel, that increases to about $100,000 to $120,000. Interestingly, these expenses can actually be driven by where you live. If you live in Sydney or Melbourne and Brisbane as well these days, the cost of living is significantly higher than in some other cities. This is continuing to expand around the world, and there is a growing differential depending on where you live and how far your income is able to go in retirement. Interestingly, this $100,000 to $120,000 band I talked about is actually a long way from the ASFA retirement standard that explains a comfortable retirement level for Australians. They say a comfortable retirement for a couple is an income of $75,000, and for a single it's around $53,000. Now, this is a great tool, great access to information, but you have to look at the detail of these things. So in this case, this includes annual domestic trips, but one overseas trip every 7 years. So if you think about that, if you're spending $20,000 on an overseas trip, this only includes, say, $3,000 of travel budget each year. And we know that barely goes as far as a flight these days. So in my experience, the people I work with want much more than that. And in order to generate this $100,000, you need to have anywhere from $1.7 to $2.2 million, depending on when you're retired and how much risk you want to take during your retirement. Another question I often get is that don't share markets or markets in general always provide 10% returns. Now, we've become accustomed to great performance in the last 3, 4, 5, even 10 years. Share markets have consistently gone up, interest rates have fallen, and everything's been supported. A lot of people that I meet and a lot of people within the industry start to model in these returns as if they're going to continue into the future. You only need to look around social media to see the power of compounding at 10% every single year. As performance is strong, these expectations start to increase. In our view and in our experience, having invested for over 20 years for retirees, these aren't realistic assumptions. This has actually been an extraordinary period for investment returns, with balanced portfolios, so diversified portfolios doing somewhere near 10%, and share markets doing even better for an extended period of time. But let's have a look more closely. There's a group called Chant West that does superannuation research and comparisons. Their balanced growth portfolio has around a 70% in growth assets like shares and infrastructure and property. That's averaged a 7% return over the very long term. And this is where we think long-term returns and objectives should sit for a more diversified portfolio that is able to balance both income and growth and build some resilience in. And that's the key here. We need to bake resilience into our investment approach, and no time is this more important than during retirement. The key here is also around risk management. So not expecting the same things that worked last year to work again in the future, and don't expect to build your income and increase your income around this higher 10% return. This can actually be uncomfortable as you start to think and adjust for the risk that performance starts to reduce, which means you might take some risk off the table, invest in lower risk assets and miss out on some good returns that come in the future, but you're setting yourself up for a more resilient, consistent and less volatile retirement. The next one I want to talk about is the insert name here. So it could be someone online, it could be someone selling a trading tool, it could be someone involved in any industry. Basically, they say this is a foolproof way to invest. This is guaranteed to make money. We provide no guarantees. There are no guarantees in financial advice or an investment. This could be borrowing to buy property, it could be investing in a single asset, or building a very simple portfolio that history has shown and backtesting has shown it performed exceptionally. Everyone has a simple, foolproof way to make money. It could be change a super fund, buy these coins, trade these options. But if there was one secret way, these people wouldn't be working. They would be wealthy on their own, and why would they be sharing that information from us? Usually the product is how they are paying the bills and making money, as opposed to having some special thing that they want to share just with you. The only foolproof way to success in retirement is threefold. It's to diversify, is to take a long-term view, and it's to build resilience into everything you do. That is in the income and in the growth that you're looking to achieve over the very long term. Another question that has been asked by almost every client I've met over the last 15 years is, why should I invest in bonds? Examples of the bonds have provided negative returns over the last few years, particularly following the pandemic and after what COVID did to share markets and bond markets. Cash gives me 3.5%. The government, the US government, the Australian government's going to default. They're going to go bankrupt. Bonds are the closest thing to risk-free assets. They're not risk-free. Every investment that you make has some level of risk. But the US, the Australian, the Japanese, the German, the biggest governments in the world and the biggest issuers of bonds will always be able to pay their interest. This can also expand into some companies that are significant, massive, large companies, things like Apple. So fixed income or bonds are very simple. They are a loan from you to someone else, to a government, to a company, in return for interest payments. And those are contracted interest payments. Fixed income, in our view, has many benefits. It provides a higher income. You can get around 4.5% from low risk government and diversified bonds today. They are fixed rate. That is, when you buy bonds today, you will receive the interest rate of the bonds that you are purchasing. They don't change as interest rates go up and down. Similarly, they offer diversification. So historically, when recessions hit, or when markets are volatile, or when challenges hit the economy, interest rates fall, which is beneficial to bonds because you've fixed that rate of income that you're going to get, and that income becomes more valuable to other people. If interest rates are cut, you have the potential to make small but positive capital gains on your bond holdings. And similarly, if interest rates unexpectedly increase, you have the risk of making capital losses, as occurred during 2022. The next question I get incredibly often, and is so relevant given the number of headlines and the incredible performance of US and Australian shares in the last 12 months, is it safe to invest today? Markets are overvalued, but if you look at the headlines, they have been for 10 years. So many people have been calling markets overvalued for 10 years. I can't buy today, I'll just wait until it falls. Oh, it'll fall 30% and then I'll buy then. This is impossible. It is so rarely done with skill. Yes, you might be right. If you're only investing in one asset or an ETF or an index, then yes, you should be worried about investing all of your money into one asset and in what is really a concentrated, undiversified pool of investments. You shouldn't be just investing into one or two assets or one theme or such a narrow pool. Retirement is all about resilience of that income and growth. We need to ensure, and you need to ensure, you have multiple ways to win, to ensure that regardless of what happens, you've got assets that have the potential to grow over the next 10, 20, and 30 years, because your retirement will extend for a very long period of time. Going from cash into markets or investing for the first time, this can be a challenging period, and this is where you need to be very careful, but this is where diversification comes in. It's easier than it's ever been to diversify across countries, to diversify across companies, against sectors, or across themes. It could be gold, it could be alternatives, it could be private equity, it could be infrastructure, but also simply across asset classes. So don't think $1 invested is $1 straight into the market. It's $1 that goes into thousands of investments, all impacted by their own inputs, which means all those things will move in different directions depending on where the economy and where the broader market goes. Now, one of the most common questions I get is, what happens if I run out of money in retirement? And this is the biggest question of all, and it can be the most emotional and concerning one that people have. Is there a fallback? What happens if everything goes wrong? What happens if I don't manage to sell my business? What happens if I haven't saved enough money when I get to retirement? The fallback is the age pension, and you can access this from 67 years of age. But the payment for this is nowhere near the income I was talking about in the first part of this video. As a couple, you can receive a maximum age pension of $46,202, and as a single, $30,646. Interestingly, in order to access the full age pension as a couple, excluding your house, you have to have less than $481,500. And as a single person who owns a home, you have to have less than $321,500. There are also options, and this is so often forgotten, that you are able to release equity in other parts of your situation, particularly if you're worried about running out of money in retirement. There's, in a lot of cases, an option to sell your house and to downsize and to release equity. And what we tend to see in retirement, and the people we work with, is that they value personal choice. They don't want to rely on the government and not changing means testing or changing payments or making it harder and harder to access the pension at different points. And how do you avoid running out of money? And that is a very simple calculation that we use, and it's I plus G equals total return. That is, income plus growth is your total return, and that's what truly matters. The key here is access to cash is incredibly important in the short term, but you can manage the risk of running out of money by always investing for growth. Now, most people are going to retire in their 60s and die in their 90s, which means you need to plan for 30 years. And if you're taking no risk, getting the lowest risk investment return that is possible, you're increasing the probability that you're going to run out of money. But you need to take risk in a positive and a measured way. And one thing that is incredibly important is constantly rebalancing. So that is selling growth assets and things that have done well to fund your lifestyle when you need them, and diversifying. So when something goes wrong in share markets, you're not having to change your lifestyle and you build resilience in. Another one I get quite often, and is massive in the comments to the videos that we produce, is why should I use superannuation? It's not my money. The government could take it away. The super industry personally and honestly hasn't done the best work in terms of encouraging people to be engaged with their money. But super is the biggest free kick you will ever have, particularly for retirees. And the government is not going to take it away. Regardless of what the headlines say, our superannuation system is the best in the world. And yes, small changes will occur, as you'll see in our previous videos. And it is the best for everyone. It's all about engaging and understanding the accessibility and how you can start using that to fund your lifestyle and to help turn off that active salary income and turn into passive. Why is it so important? Because the income and capital gains are taxed while you're saving at 15% and 10%. But once you start drawing a pension, once you turn 60, stop work, or turn 65 and start drawing a pension, all of this tax rate turns to zero, which means you're not paying any tax. You're actually getting a refund of tax if you have franking credits. And similarly, contributions tax is only 15% during your lifetime, which means it's lower than all the marginal tax rates. And once you turn 60, you can take out all your superannuation if you wanted to, as long as you met that conditional release, tax-free. All benefits after 60 are tax-free. One of the most relevant that I've seen more recently is the big question, which is it worth paying for financial advice? I've been doing it so well myself, then why would I pay for financial advice? And there's nothing like a bull market to make us all feel like experts. Share markets have gone up, ETFs have gone up, pick anything, buy anything, and you've done reasonably well. The thing here is it's all going well until it isn't. Some people may be able to stay invested if the share market falls 20, 30, 40, 50, 60% like it did in the global financial crisis. And some people may be able to understand the basics of superannuation laws, but to have the objectivity and the resources to be able to put it together consistently, to execute and not make mistakes, that is where the real challenge lies. To make hard choices at hard times when it feels like you should be selling everything and saving as much money as you can, or to use the experiences of hundreds of others to identify strategies that are suitable for you. Something as simple as stopping you from selling at the bottom of the market or buying at the top can completely change the trajectory of your retirement. And similarly, maximizing the tax benefits, ensuring you have the highest after-tax income possible, and timing everything perfectly, not exceeding contribution caps and not making a mess of what is a complex superannuation system at times that has around 20 different tax rates. Now, if you're interested in learning more and learning how to get ready for your retirement, I've provided a link to our Australian retirement checklist. And as always, please follow, subscribe, like the page and comment, and any video ideas, please share.